All right. So, Joe, thank you so much for being with us here today. Hopefully, everybody can hear me okay. Can you hear me okay, Joe?
I sure can.
Awesome, awesome. So we have several different topics, not topics, several different questions along the topic of debt structuring and finance that I wanted to run by you and get some of your knowledge on. But before we get started, I wanted to do a little bit of an introduction of you and myself. And so for those of you who have not really followed Joe very much, you can actually go to our podcast at toughdecisions.net, and he is on episode number 4. So just go to toughdecisions.net, either type in Joe Fairless or type in TD04, and his podcast episode will be on there. You can also visit his own podcast at joefairless.com. And then one of the other things I wanted to mention to the listeners is I wanted to bring this book up, Joe, and I know we didn't really discuss beforehand me talking about this book at all, but I think it's a phenomenal book. There's been lots of great reviews on it. I've talked to a lot of people about it, and you also have a lot of good resources on the apartmentsyndication.com website, which I think is very valuable for the listener. And so first thing I wanted to do first is for those of you who are listening, if you're in apartment syndication, go to apartmentsyndication.com. There's a lot of resources on there. There's articles, there's videos, there's training. Joe has done a phenomenal job of putting that information together. And then he also has this book, Best Ever Apartment Syndication Book, which you can find on Amazon.com. It's interesting, Joe, because I've talked to quite a few people and I say, hey, do you know Joe Fairless? And with as big of a name as you have in this space, a lot of people still don't know who you are. And it just goes to show you about how big this space is. And so my goal with bringing you on is to also let other people know on the Multifamily Investor Nation page about you and what you're doing and all the good stuff that you're doing, because I really like a lot of those things that you're doing as well. Before we dive into some of the content, for those people who have joined us who might not really know who you are and what your background is, can you give a brief, background about where you're from, where you've come from, and where you are today?
Yeah, sure. I mean, who I am, I'm focused on providing value, and my mantra, one of my mantras, is the secret to living is giving. I got that from Tony Robbins. And Zig Ziglar talked about help enough people get what they want, you'll eventually get everything you want. So that's my approach, and that's what I do. That's how I approach my business. From a business standpoint, I'm apartment syndicator. I've got a little over $400 million worth of apartment communities, about 4,500 units my company has with investors, and we we buy apartment communities, we add value to them, and then we either hold on to them or we exit out and go into another deal. From that's it from a high level. All areas of my business have a direct or indirect philanthropic component to them. Indirect would be money I make from apartment syndications. I contribute back to different nonprofits that I'm involved in. Direct contributions would be for my first 2 books. All the profits from those books went to and still goes to junior achievement. It helps kids in underserved communities learn entrepreneurial skills as well as just financial skills. And I've done a scholarship for Texas Tech students for I don't know 5-6 years, where I've sent a student or 2 students up to New York City and have then shadowed people at advertising agencies, and then with the hope that helps inspire those students to then move to New York City and start their career versus maybe starting in a smaller market. So I do a lot of that stuff too. Also have a podcast, as you mentioned. It's the world's longest running daily real estate investing podcast, and have a conference in Denver, besteverconference.com. And then have a book that came out about 2 months ago called Best Ever Apartment Syndication Book. and it's all about how to do apartment syndication, which is very topical for our conversation.
Well, and one of the things that you really focus on is the larger apartments, right?
Yes. Yep. 150 plus units built between 1980 and 2005 in a major city. That's more important on the exit, not really when you go in. The reason why, when you go in and you're buying in a tertiary market, so a market that's like less than 750,000 population according to the MSA, Metropolitan Statistical Area, as defined by the census.gov, then you can get anything less than that, you can get better cash flow, but it's tough on the exit because you don't have as many buyers. Therefore, if you don't have as much demand for what you have, then it's going to decrease the value. So we look for major markets that we are buying in. All of our portfolios in Texas right now, most of it, about 98% of it or 95% of it's in Dallas, Fort Worth. We have a property in Houston. Besides that, it's DFW. And they're all going to be value add deals within that range and at least 150 units.
Well, and I'll throw it out there that I'm an investor in a couple of your deals as well, and so I obviously like working with you and like everything that you're doing. One of the things that people always ask me is they know kind of that you are my mentor in the space, and they say is Joe the guy for me? And one of the things I always say, and you can correct me if I'm wrong, but I always tell them, I'll say, if you want to play in a big way in the big space, 100, 150 units or more, Joe is your guy. But when you want to play in a little bit of a smaller space, there's nothing wrong with that per se, but I don't really feel like that's really what your bread and butter is, what you really focus on. Would you agree with that?
I've never bought anything between 4 and 154 units. I've only purchased single family homes. I don't buy those anymore, but I started out with single family homes. And the smallest property other than a single family home is 155 units. So because I don't have the experience buying properties that are 30, 40 units, I wouldn't be the best person to give advice on that. However, anything 100 units plus, or really probably 75 units plus, lessons I've learned certainly are applicable. But, it's interesting. I was just right before our conversation started, I just gave Theo a call, and Theo's a team member of mine. He co-hosts a podcast with me on most days, and he wrote the book with me, all of them actually. And I just called him. I said, what's an interesting topic to write about? And so he and I are going to write about this blog. He's going to put the outline together. Then we're going to knock it out together. Is why do smaller apartment buildings have a lower expense ratio than larger ones? And because I have some ideas, but I personally don't know why, because I haven't bought smaller properties. But like a 30 unit, I was interviewing a woman yesterday at my meetup in Cincinnati, and she has a 9 unit, and she said her expense ratio was about 40%. And that's about par for course with properties of that size versus if her 9 unit were 150 units, that ratio is probably going to be about 50, 55, maybe 60%, depending on who pays what. So, I don't have direct experience, but I am involved in a lot of those types of deals that are 75 plus through clients in the program. And I do find it interesting, and I'm learning just like everyone else every day.
Yeah. Well, and obviously being able to be in the large space and taking down quite a number of deals and very large deals, you have quite the depth of knowledge when it comes to debt structuring and finance. And as the listeners are on with us, whether you're on Facebook Live or whether you're on the Zoom platform, if you're on Facebook, you can put in a question into the Facebook Live, and if we have time, we'll make sure we get to your question. And same thing for those of you who are on Zoom, you can use the Q&A button down there on the bar and just add in some questions. But to get us started, Joe, I want to ask a few questions myself. and just to kind of get the conversation started. And then as we're going through it, people will probably have more and more questions. So first off, can you go over two of the main types of debt financing that you typically find in apartments?
Agency and bridge. Those are the two main types of debt financing. So let's talk about when each is a most likely or most commonly applied. Bridge financing is most commonly applied when you have a value add deal that isn't stabilized, or perhaps it's close to stabilization, but it's not quite there, or is completely distressed. So you put a bridge loan on it because it's bridging the gap between where you are currently in a non-stabilized state to where you want to be in a stabilized state. So what's stabilized state? Well, it depends on the lender and how they define it, but 90% occupancy, 85% economic occupancy. You'll want to have, and there are other metrics for that, but you'll want to look at the property and first see if it qualifies for agency debt, which is Fannie Mae, Freddie Mac loan, or if not, then a bridge loan. But even if it does qualify for agency debt, Fannie Mae, Freddie Mac, doesn't necessarily mean you should do it, because let's say you have a property that is stabilized, but you have some sort of value add component to it that is going to make a big difference on your NOI. Let's say you're going to be instituting or implementing a RUB program, ratio utility bill back services. Basically, you're billing the residents back for the amount of water that they use based on, how much they use. And you're also renovating the units through the typical interior renovation plan. Well, if you plan on having that property for, say, 4 years or 5 years, and you're going to implement that plan out of the gate, then you'll want to have flexibility to realize the value that you just created and get a new loan on the property so that you can get equity from the property. Now, you can still do that with an agency loan, and instead of a refinance, which you would do on a bridge loan to get that equity out, you would do a supplemental loan. So you'd get a supplemental loan, which is keeping the existing loan on the agency debt, but adding an additional loan, a supplemental loan, to that, so that you can then, you're basically putting more debt on the property, but you're okay putting more debt on the property because now you've got an increased value of the property, so you can get money out. Well, with the bridge loan, if you have a shorter time frame that you want to exit out of the deal, the bridge loan will give you more flexibility than agency debt. Agency debt's more intended for holding on to it longer than what you would plan on holding a deal with the bridge loan. So you have more flexibility, but you also have to be careful of certain things with the bridge loan. For example, one of them is you draw down on the bridge loan with your CapEx projects, assuming that that's part of the loan, which it usually is. And so when you have a bridge loan and you are needing to use money from that loan to renovate your units, well, in order for them to release funds to you to do those renovations or reimburse you for those renovations, you must be hitting certain loan covenants. And those loan covenants depend on the lender, but some of them include certain collected income, certain NOI, certain occupancy, economic occupancy. And if you come in a rough spot or come across a rough patch during your business plan, you're going to be in trouble if you're not hitting or achieving those loan covenants, because then you won't get those renovation dollars in order to complete the business plan. And usually that's the number one thing you need at that time. If you're in a tough spot, you need the dollars to then continue to push through whatever challenges in front of you. But that's not how it works. You have to maintain schedule, stay on schedule with all these loan covenants. So it's important when you have a bridge loan to really look at your underwriting and make sure that those loan covenants are something that you're comfortable achieving. And then if you don't achieve it, make sure you have a contingency plan before you bring on the loan to your deal, so that you know, okay, if worst case, we are in the renovations and they're just taking longer than we thought, they're more expensive than we thought, a hurricane comes and we have to get an insurance claim, and it takes a while to get the insurance claim. In the meantime, we still got this loan, and now our occupancy slipping because there was a hurricane. There's all sorts of scenarios where you might slow down or might not be on schedule financially or from a timing standpoint. You need to have a backup plan. One backup plan is make sure you have a contingency budget of at least 5% of whatever the total equity is that you brought to the deal. So that you can then use that contingency budget, that operating budget for that type of scenario. So that's the bridge loan.
A couple of questions that I have along through this. Number one is, when you're talking about the supplemental loans, are you referring to like a mezzanine loan?
Supplemental loan is basically like a second mortgage. It's just another loan on top of the existing loan, and that is when you have agency debt. So you don't put a supplemental loan on a bridge loan. You do a supplemental loan with agency debt, because the reason why is, like for example, we have a loan that we're going to be getting on an upcoming acquisition, 12-year loan, 5 to 6 years interest only payments, 4.53% interest rate, fixed and locked in. Well, what are interest rates doing right now? They're going up. And they may or may not continue to go up. I think they will. And if they do, then that's certainly going to be a loan that we want to keep. Now, it's a 7-year project. We're planning on holding the property for 7 years. During these next 7 years, if and when interest rates go up, then we're still locked in at 4.53%. So we certainly don't want to say, well, we did our business plan in years 1 and 2. Let's refinance out of this loan and let's put a new loan at the current market rate interest rates, because it's likely going to be much higher than 4.53%, what we locked in. So instead, we do a supplemental loan, which is a small percentage of the larger loan in terms of what we're being loaned. And it is at the interest rates that are market at the time, but it's such a small percent of the overall loan, it doesn't make a huge difference. But what it does do is it returns capital back to our investors in a shorter period of time. And one mistake that we've made in our setting expectations with investors, and we'll never, ever do it again, is on our second deal, we projected that we would refinance in year 2. And we put those projections from the refinance into our projected profits when we were talking to investors about the deal. And that's not a good way to set expectations, because we thought it was likely that it was going to happen, but then we had 2 hurricanes and 1 fire within a 30-month period. And so we did not refinance within 2 years. We ended up selling in 30 months. So 2.5 years. And we did really well. And we exceeded expectations overall for the project in terms of an annualized return. It was 25% annualized cash on cash return to our investors. So we did very well for them. But we put ourselves unnecessarily up against the wall when we put those projections in the documents initially. So when you're looking at these loans, when you're underwriting your deals, and when you're speaking to investors and you're putting together the investor documents, my suggestion is to not model in a supplemental loan or refinance, but mention to them that this is the business plan. This is what you anticipate doing, but to be conservative, you're not putting those in the projections, which we did not do after that second deal.
That makes sense. Would that also make that 11 or 12-year fixed rate of 5.53 attractive to be able to have the person who's going to buy your loan at that point, depending on how the market and the rates are, want to assume that loan?
Yeah, incredibly. And just to clarify, it's 4.53%, not 5.53. Yeah, 4.53% fixed. Yeah, that's a big deal. Interest rates, let's say they go to 7%. I mean, they've gone up higher historically than that, but let's say they go to 7%. I mean, holy cow, 4.53% fixed. That increases the value of our property, because we've got a very marketable property with a very marketable loan that they can assume. And that's going to make us very attractive, especially since it's a longer term loan. So let's say in 2 years, interest rates go up to 7%. Well, we've increased the value of the property through our business plan, years 1 and 2. And now we got 5 years on this, 12 years total. So we have 6 years 5 to 6 years interest only. So we have 10 additional years on this loan, and the buyer can assume this loan and hold on to it for 10 years, with 3 to 4 of those years being interest only, which is a big deal. And that's something we haven't talked about, but I'll mention that with interest only, no matter how you run the numbers, if you're a value add investor, the numbers always work out where you want as much interest only as you can possibly get. The single family investor's mindset and my initial mindset might be, I want to pay down some of that principal. Like, I don't want all that debt. I don't interest only loans. That's a risky proposition. But in reality, because you're adding value to the deal, providing your investors returns based on interest only, and then increasing the valuation, then getting a new loan based on that increased value, works out in your favor 10 times out of 10. So you always want to get as much interest only as you can on your deals. And in bridge loans, they have different structure than agency debt. And so, like I mentioned on this loan that we're getting, that's Freddie Mac, we're getting 5 to 6 years of interest only on a 12-year loan.
What's the biggest concern for a bridge loan right now in the market? Is it really just kind of a bridge loan is usually a floating rate, and so it's kind of hard to determine where that's going to cap out at?
Well, even with the floating rate on the bridge loan, I suggest that you buy a cap on that, and you'll talk to your mortgage broker about what that costs and how you do that. But that will cap your downside on what interest rates can be, so you can actually cap out whatever the interest rate will be, regardless of what the market is. The biggest risk on a bridge loan is the execution of the deal doesn't go according to plan. And they're, bridge loan, they're shorter because they're just bridging the gap. You don't have a bridge that goes from, New York to Los Angeles. You have some highways that are connected, and I'd consider the highways more agency debt in this example. And, the bridge, it's not feasible to do a bridge loan or a bridge from LA to New York until Elon Musk does something underground. And that's a whole nother story. But with the bridge loan, the biggest risk is you not executing. And that could be any number of reasons why. The market shifted. Many employers left your market and submarket, and you now had to drop your rentals, your rental rates. and increase concessions, and consequently, you're not hitting the loan covenants that were set forth. And so now you're not getting any funding from the bridge loan, and now you don't get the funding from the bridge loan. Now you can't continue to execute your value add plan, and you can't execute the plan. So now what do? You've either got to get additional cash, or you don't execute the plan. If you don't execute the plan, then depending on where the market goes, if it continues to worsen, then you might not make the money back that you initially put into it, because now it's not worth as much. You've got a half-baked business plan that has been halfway executed, and now you're a distressed seller. So there's the execution is the biggest risk factor in any value add deal. And when you do a bridge loan, it compounds the risk profile of the deal. Now, on the flip side, it can also substantially increase your returns because you're not locked into the loan. The buyout period is much easier to digest than an agency loan. So you've got some pros and cons there.
On this same piece here, what actually happens if you don't execute and you don't perform? Do they force a sale, or what happens to the actual property, or if you're not hitting those covenants?
You got to pay up. It's a balloon. You got to. It likely won't happen overnight. You'll definitely see it coming. Well, you'll likely see it coming, and if you don't, then you could be sued for incompetence by all your investors, because you should see it coming, because there will be conversations that take place with your lender, with your mortgage broker leading up to that. So you should be aware of it, and your investors should also be aware of what's going on. But ultimately they take the property. That's what is used for collateral, and they can take the property back. And that's a doomsday scenario for everyone, and perhaps even the lender, but more so for you and the rest and all of your investors.
I think the biggest thing is if you're not hitting those covenants and you're not hitting those targets, then they're not going to continue to give you the ability to draw down the CapEx either, so you can't even complete your plan.
Yeah, so that's where you really got to bring in additional capital, or like we were talking about earlier, have an operating budget that is at least 5% of whatever equity you bring to the deal, and that's just sitting there in the account, and you don't plan on touching it, but if you do, then that's what it's there for. It's for the the rainy day scenario should something unexpected happen, so that you can push through and continue to finish out the business plan. And it's also important to get outside advice, because if you're in that situation, then something was flawed in your judgment leading up into that point, regardless of, let's say it was some mother nature occurrence. Well, barring a complete catastrophe, you likely still should have had the funds required to pull you through that period of time by having a proper operating account. So if something challenging does take place, or when it does, before you immediately go out and try and get additional capital to bring to the deal, get some advice from other people who are in the industry and have successfully executed similar deals that you have right now, because there might be a different approach that you need to take. You might need to just sell. You might need to fire the management company before you put in the cash, because it might be more on the execution and the management company not holding up their end of the bargain. Might be you need to step aside because you don't have the skill set required in order to be successful on overseeing the project, and you need to put someone in place who has that skill set. It might be a combination of all of those things. So it's one thing I've seen real estate investors do, and it's a mistake, and that is continue down the path that got them to where they're at when they're messing up, and not pause, be honest with yourself and say, wait a second, I know all this crazy stuff outside of my control is happening, but let's just pretend for a moment that some or most of it was under my control. If I had taken other decisions leading up to this, that there would be a different outcome today. Because of that belief, then let me bring in some other people and get their advice and see what the best approach is, so that we can truly identify what the underlying issues are. It's going to be obvious what the surface level issues are. You know, it could be you're not getting the rents you thought. It could be your renovations are going much, greater or higher than what you thought. It could be there's a lot of rain and the foundation started getting messed up. But identify the underlying issues first before you address the surface level issues. That way you get to the root of it, and it mitigates the risk of the underlying issues causing more surface level issues once you resolve the surface level issues.
So is it also a risk that, during the potential recession or correction or whatever's coming up, that you won't be able to refi into the permanent agency debt?
Yeah, sure. Yeah, that's a risk too. When you have a bridge loan, you'll usually have a 2 to 3 year loan with 1 to 2 year, 1 or 2 1-year extensions. Therefore, if you do the business plan, and let's say you plan on doing a value add deal or value add business plan, renovating the interiors, light exterior work, nothing major, and you plan on doing it in 2 years. Let's say things happened, who knows what, many things I just talked about earlier, and now you're at year 3 and you're closing in on it, but unfortunately the market has taken a turn, and rents have softened, and interest rates are 7%. We'll keep going with 7%. Well, what do? You got 2 years left on the loan, 7% interest rates for agency debt, and the market softened. What I would do is I'd exit out of it. I'd exit out at that point in time, unless there's some indicator that shows us with confidence that the market's going to change in 2 years. I would rather lose some or break even on the deal than hold on to it for 2 additional years, assuming that we're not cash flowing in this scenario. Hold on to it for 2 additional years or 1 additional year and roll the dice and hope that things change in another year. I would rather be more conservative and cut my losses than risk more losses and an even worse buyer's market. So yeah, it is a risk, but that's the risk with all commercial deals. I mean, it's not just multifamily, it's any commercial deal. There's going to be a balloon payment. And that's something when I was, a single family investor, I didn't realize that when I first started studying this stuff. I was like, wait, 30-year loan, 30-year amortization, I pay it off, interest, principal over 30 years, and then it's ours, free and clear. Well, not so much in these deals. You're going to have a balloon payment in 5 years or 7 years or 10 years, 12 years. You can do 30 years, but that's not a value add business plan. Or usually it's not, unless you have some investors, likely 1 or 2 investors who want to hold on to it for generations, and you put that type of debt on the property. But that's a different type of business plan.
Have you ever used a hard money loan, or would you even advise somebody to use a hard money loan to get into one of these types of large deals?
I have not. And Well, I mean, I think a bridge loan certainly a close cousin to a hard money loan. I guess it might almost be semantics on how people categorize them and how you're defining a hard money loan. Uh, but I think usually when I think of hard money loans, I think of you know, some guy in New Jersey loaning me a couple million at 20% interest and 2 points at closing or 5 points at closing. We go back to this Italian restaurant to sign the paperwork, that type of thing. So no, I wouldn't recommend that type of loan on any deal ever. But sometimes investors roll a dice and do what they think they need to do, and sometimes it works and other times it doesn't. I've never done that.
What about using a local bank, like a community bank or something like that for some of these deals?
Yeah, especially for 75 units plus or minus 25 to 50, because that tends to be in the sweet spot for the community banks. And they know the property, or they know the area the best. In theory, they know the area the best, and they can they're portfolio lenders, so they keep the loan in their portfolio, whereas other lenders sell it, either sell it on the secondary market or do something else. So portfolio lenders are helpful, especially with 75 to 100 units. A community bank or a local bank usually doesn't play in the space that we play in. I mean, we're buying a property for roughly about 50 million coming up, and that's not typically a loan that a local bank will do. But there's certainly some that go in the smaller range, and that's I know some clients in my program, some people that we both know, they go with local banks on deals. I know one in Louisville that just did phenomenally well on his deal, and he used a local bank.
And is the local banks, are they typically doing recourse or non-recourse?
Both. I think it just depends on the local bank. That's the beauty of them. It depends on the amount, depends on the deal, depends on your experience and your track record, as well as your balance sheet, how much you put down, and it depends on what type of program they have set up. That's always going to be a wild card. I mean, in general, their rates are going to be a little bit more expensive. Their interest rates are going to be a little bit more expensive than, say, a national lender, but they can be more flexible. Similar to any investor who's watching or listening who does, a decent amount of single-family homes. You can go with a local bank, and they tend to be a little more flexible, right? You can get more transactions done with the local bank based on your relationship, but you're going to pay a little bit more, and you're okay with that because you can do more deals. Similar with the larger stuff, they're going to be a little bit more expensive, but they're going to be more flexible.
What are the typical loan requirements for an agency loan or one of these bridge lenders?
It's going to be 100%. Whatever the loan is, 100% your net worth needs to equal 100% of the loan. So if you got a $10 million loan, then you need to have a $10 million net worth, and you should have 10% liquid post closing. So again, $10 million loan, then you need to have $1 million liquid after closing. And so meaning the down payment that you have doesn't count towards it. So that's from a financial standpoint. From an experience standpoint, you've got to have. I don't know the exact clear cut requirements from an experience standpoint for the, it depends on the lender, but for agency loans, I know certainly you'll need to have someone on your team who has a track record doing similar deals, and they need to be in the GP on the GP side. So, track record of similar deals, 10% liquid and 100% net worth are, if you've got those pieces in place, then you're likely going to be approved. Assuming that, they also look at your credit. They also make sure you're not a criminal. I've never been arrested. Don't plan on being arrested. I'm not sure if you have a misdemeanor or, some other run-in with the law, what that would do to the approval process. Fortunately, I don't know. But those are also some considerations. I'm not sure what the minimum credit score is, or if there is one. Certainly, if you have a bankruptcy, then you're going to need to explain that. It's going to need to be a certain period of time since you got the loan, and or you need to have people on your team who can strengthen that credit profile of yours. So those are other considerations.
And that doesn't necessarily, from the net worth and liquidity standpoint, doesn't have to be one person. It's like the overall, aggregate of the entire GP people, everybody in the GP, right?
That's correct.
Yeah. Okay. And let's say there's a particular person or a particular group, and they're trying to get a $10 million loan, but their aggregate is 3 or 4 million, and they need to be able to bring on some other type of person like a KP or a loan guarantor. How do you compensate that loan guarantor?
It varies depending on what you want to compensate them and what they're willing to do what they're willing to be compensated in order to do that. Yeah, usually it's some sort of ownership in the deal plus a fee at closing or a fee on an ongoing basis. So that ownership in the deal can range from 5 to 30%. I've seen, and that's just to bring your balance sheet and net worth. So I'll be clear: bring the net worth balance sheet plus your liquidity. And if it's on the higher end of that range, it's also going to be your experience, where they need someone to have some experience too. Because let's think about this: if a group has not a net worth that qualifies, not a liquidity amount that qualifies, and not experience that qualifies, do you really want to sign on the loan with them? And if so, yeah, it's going to be in the 30% range or so. I mean, that's you're risking a lot. Now, it's likely a non-recourse, unless it's a bridge loan, then it might be recourse. But we've always done non-recourse, even our bridge loans. But it depends on the lender. If it's recourse or non-recourse, that's a big variable in terms of what the percent is of the GP. I mean, if someone's the worst case or the most, the biggest ask would be, I need net worth, I need liquidity, I need experience, and it's a recourse loan. I mean,
and they need you to put up hard money.
Yeah. And I need all the equity, and will you please do this for me?
So you're just bringing the deal, and that's it.
Right. Oh, and do you know any brokers with the deal? Yeah. I mean, and then it gets a little wacky. I mean, then you take 100% of the deal or 99.9, and you let them watch the deal from the sidelines. But, it just depends. And so that's the ownership percent in terms of let's be, I'll be clear. If I'm, a 20% owner in the deal on the GP side, then I'm participating in 20% of the profits and all the fees, acquisition fee, asset management, whatever it is, whatever fees are in the deal. And then there might be a fee at closing that's based off of a fixed amount. say 50, 75,000, 25,000, whatever you all agree on. And or there might be an ongoing fee for a certain percent, say 0.25% of the loan balance paid out every year. It just, there's a lot of different ways to slice it.
So I have two more questions for you, Joe.
Cool.
So I know we're going to wrap it up here right at 3:30 to keep you on time. We have a question that has come in off of Facebook that basically is, in the past, we've seen a lot of sponsors putting together deals where you're seeing 20 to 25%, down payment, or you're having a lower or a lower LTV than you have seen in the past. Is that more risk for the GP when you're having to raise more money? Not for the GP, more risk for the LP when you're having to raise that much more money in order to make the deal go through?
Is it more risk for the GP, or is the deal riskier for the LPs if the loan to value is lower? Did I hear that correctly?
Correct.
No, it's safer. I mean, the loan to value is lower, then the deal's safer for the limited partners. The only thing to keep in, well, there's many things to keep in mind, but one thing that comes to mind is as an LP, you'll want to make sure that the GPs are conservative in their projections, because if the LTV is lower, 65% or lower, then it's likely that the projections will be lower too, because you're have a lower leverage on the money. Therefore, I think there's increased risk if the GP is not conservative. There's increased risk in not hitting your projections, but the deal is less risky because you have a lower LTV.
And is the lower LTV usually because the bank is forcing the lower LTV, or is it because the sponsor is trying to make it less riskier for the overall investment and lowering it and trying to raise more?
You have to ask the GP that question. I don't know.
Just depends on who's putting it together.
Yeah.
So my last question for you today is, I've been bombarded with many types of lenders and brokers and various options, and a lot of times we can get lost in this sea of brokers and lenders reaching out to us and wanting to sell us the best thing. And of course, we all have heard of being retraded, where a lender tells you one thing and then you get it locked up, and then a week before closing they change things up on you, which I think is one of those things that's going to be inevitable. But how do you really try to vet a lender or a broker to make sure you're working with the right person and that would be the best thing for your team?
Well, you should be working with a mortgage broker when you're dealing with larger properties, because you need an advocate to go to bat for you on an ongoing basis and be able to communicate to the lender, one, here's what your competition's doing, and then two, I have other clients and I have more buying power from you than just one person. So you're dealing with someone who is a gatekeeper of a lot of business for the lender, so you have more pull with the lender. So really the question is, and if you're dealing with a community bank, then you won't be dealing with a mortgage broker, nor should you. There's no reason to do that, because you're just handshake deal and you're working with the local person. But generally, you want to work with a mortgage broker. And how to qualify the mortgage broker is word of mouth. Ask people who they work with, and then get those referrals, and then just talk to the referrals. I mean, it's not groundbreaking, but it's an exercise that a lot of people don't do. You should know who your mortgage broker has worked with in the past. You should have spoken to them prior to engaging with them, because you and I have talked about this. When you've got non-refundable money on the line, the number one reason why you're not going to close and why you're going to lose that non-refundable money is because the lender backs out or delays things, backs out completely or delays things. We've had a lender on our very first deal. We had a lender back out completely. It was in Houston. Oil prices were just going down, 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 and they backed out completely. We had to scramble and get a new lender in place, and we bought it for $14.1 million, appraised for $21.6 million, 12 months or 15 months later. So we did really well, but we had to scramble in order to make it happen. So those are the things I would do in order to mitigate that risk. Make sure you have a mortgage broker and then qualify that mortgage broker.
Well, Joe, any last minute thoughts you want to leave us with before we're wrapping this up?
Enjoyed our conversation. I'm all good.
Well, thank you so much. And for those of you who want to follow Joe a little bit more, you can go to the apartmentsyndication.com website, and also has a link there on the top bar to see the books that he's written along with Theo Hicks. And his latest one is the Best Ever Apartment Syndication book. I have it sitting on my shelf right now, and I recommend any of you who are watching and listening to go ahead and grab that book. And thank you again, Joe, for taking the time out of your schedule today to be with us. Look forward to having you on a future Q&A session with us.
All right. Enjoyed it. Thanks, everyone.